All right, let's get right into it. As of February 2026, Nykaa is at what you'd call a strategic inflection point. The whole narrative has flipped, really. It's moved away from that growth at all costs startup mentality to something much more like a mature, profitability-focused retail powerhouse. The fundamental story has changed. So, how did Nykaa get here? To really get a handle on where the company's going, we've got to look back at its journey over the last 5 years. It's been a period full of market shocks and, honestly, some pretty crucial internal pivots that have completely reshaped their strategy. And what a journey it's been. After that blockbuster IPO in late 2021, the company hit some serious volatility just a year later when the early investor lock-in period expired. That turbulence, though, it forced a major strategic pivot. During fiscal 23 and 24, the whole company's focus shifted from just pure growth to sustainable EBITDA and solid unit economics. And that paid off. By May 2025, Nykaa hit its first consistent streak of profitability, which brings us to today, where their strong Q3 results show they're successfully fighting off some new threats. Okay, so now for the bull case. What are the core strengths that have analysts believing Nykaa has built this formidable fortress in the Indian retail landscape? Let's break it down. It all starts right here, with their crown jewel, the beauty and personal care segment, or BPC. This is Nykaa's unshakable fortress. I mean, even with new, aggressive competitors jumping into the market, Nykaa has held its ground, commanding a massive 25 to 30% of the online prestige beauty space. They are, without a doubt, the undisputed leader. And this leadership isn't just sitting still, it's still growing at a really impressive rate. The company is keeping up some strong top-line momentum, with that BPC segment's revenue growing at a compound annual rate of over 20%. We just saw this again with their outperformance in the Q3 results for fiscal 26, which were driven by some very healthy sales figures. Growth is great, but profitability is the new mantra, right? Management is now guiding the market towards a significant expansion in their EBITDA margin. The long-term target they've set is somewhere in the range of 6.5 to 7%. And, with a consistent streak of quarterly profits already in the bag, the path to maybe even double-digit margins is starting to look a whole lot clearer. So, the big question is, how are they expanding those margins? Well, a key driver here is the strategic shift from just being an aggregator, selling other people's stuff, to becoming a creator of their own high-margin brands. Private labels like Dot & Key deliver way higher gross margins. So this isn't just about selling more products, it's about controlling the value chain and building a high-margin moat around the entire business. Now, this slide is really interesting because it represents a huge turnaround story. For years, the fashion segment was a drag on the bottom line, a real cash burn. Well, that phase is over. It's now at what they call a contribution neutral stage. It's a technical way of saying the really expensive work of acquiring customers is mostly done, and the segment isn't draining the company's resources anymore. It's finally paying for itself. And to wrap up the bull case, you have to look at their unique physical advantage. With more than 100 stores across India, Nykaa has built a true, seamless omnichannel experience. This is something that pure-play digital competitors find incredibly difficult and expensive to copy. It gives Nykaa this durable competitive edge that's just tough to beat with online ads alone. But, of course, no fortress is ever completely safe. So let's flip the coin and look at the bear case. Let's see how the competitive siege is shaping up and talk about the key external threats and internal risks that Nykaa is facing. The first attack came from a direction nobody really expected: quick commerce. Players like Blinkit and Zepto came in hot, using speed as their main weapon, promising 10 to 30-minute deliveries. This was a direct challenge to Nykaa's standard 2 to 3 day shipping, and it created a pretty big service gap in the eyes of impatient consumers. But Nykaa didn't just sit there. They responded, and they responded decisively. They launched a counterstrike called Nykaa Now, and this hyper-local fulfillment service has been incredibly effective. As the data shows, they're now fulfilling 30% of all their orders in Tier 1 cities in under 2 hours. That move has basically neutralized the pure speed threat from those generic Q-commerce players. The second threat, and this one might be more of a long-term battle, comes from rivals with incredibly deep pockets. I'm talking about corporate giants like Reliance with their Tira platform and Tata with Palette. These are well-capitalized players, and they are competing aggressively, driving up marketing spend and customer acquisition costs for absolutely everyone in the industry. And there are a few other key investment risks to keep on the radar. The stock still trades at a premium valuation when you compare it to its global peers. There's also the risk that rural consumption might recover slower than expected, which could hit sales. And finally, you have the potential for equity dilution if the company decides to go after more big acquisitions down the road. So we've got the bull case and we've got the bear case. Let's try to put these two arguments together and come to a more nuanced, forward-looking verdict on where Nykaa really stands today. So let's just do a quick recap of those core strengths that support the long-term thesis. First, the fashion segment has turned the corner. It's now self-sustaining. Second, those high-margin private labels are boosting profitability across the whole business. And third, they've proven they have an effective game plan against the quick commerce threat. Check, check, and check.
So what does this all mean? Well, our final verdict is that Nykaa is a compounder in transition. It has successfully clawed its way out of that post-IPO value trap period, that tricky phase when the stock price just doesn't seem to reflect the company's real potential. Now, its valuation is still at a premium, no doubt, but you can argue that's justified by its leadership position in such a high-growth market. The key takeaway here, this seems to be a company that requires a long-term investment horizon, leaving us with a really fascinating question: just how high can this retail fortress actually be built?